As you probably know, it was an incredibly volatile last week. So volatile that our firm saw our best and worst days ever in history on consecutive days. However, despite the volatility, the S&P 500 ended the week down less than 0.5% from where it started. What does this mean, and where do we go from here? Let's begin by sticking with the facts, what actually occurred, and not letting price dictate our sentiment. That is the biggest mistake that happens. We definitely saw that on the upside. Stocks that were up, obviously got chased into. People perceived the price going up as being a bullish sign, and those same people are now burned. And they didn't get burned yesterday. They've been burned for almost 6 months now. Anyways, this week, there are two things that stand out to me. One is the Fed. The Fed came in expected, at least at the highest probability of expectations. There was certainly the presence of expectations for 75 basis points at this meeting. JP Morgan assigned it at a 20% chance. I'm sure other firms signed it at similar, higher and lower percent chances. And then the potential for that at future meetings. It seems like that is off the table. However, I've heard multiple good points today that say that it might not be off the table. 75 basis points might be on the table. My conclusion is, didn't happen at the most recent meeting. We'll know and we'll hear about it if it comes. We kind of heard one Fed member mention it today, flirt with that idea today. Seems unlikely for now, but not entirely off the table. We'll leave it at. And then we got the jobs data. And I think the jobs data was a little bit of a Goldilocks type of situation. I'm not saying it was massively Goldilocks, but it wasn't negative. It certainly was not negative. Wages were up, yes, but less than expected. And jobs beat expectations. If, basic economic forces are going to hold, you would expect that when the labor force participation rate goes down and more people are hired than expected, that wages would be up more than expected. They're not. I'm not saying, wages is the most important thing, but it is contributing to inflation. And I think some modest wage increase, or at least not a wage collapse, is actually a good thing. We want people to be making money, having a strong economy. I can tell you for one, when I'm making more money, I am spending more money. And I think that's the case with a lot of people. That's just like the way it is. Or at least you're saving less, or skimping out less, being less cheap. So strong wages, yes, it's contributing to inflation, but it's also putting more money in consumers' hands. And if you listen to what the banks have to say about that, they're saying the consumer and the economy are incredibly strong. So let's calm down about this massive collapse in the economy. I'm not seeing it yet. Yes, prices are high. That's certainly true. Prices are high. But spending isn't down tremendously. It seems to me that it's simply shifting. We're seeing e-commerce companies get hit, but we're seeing 1.8% year on year, but we're seeing in-person retail up 10% year on year. Maybe there's a broad retail hit. Who knows? Some people do. I don't. What I do know, though, is travel demand is quite high, and some sources I've heard saying higher than Q1 2019. So the economy, I don't think, is wavering in any meaningful way. People are very much worried about inflation. That seems to be what's causing the most recent pullback. I am not worried about inflation picking up. And those of you who watch these videos know I've been long energy for over a year now. I've been short bonds for almost a year now. I've been short the market just 2 weeks ago. And I am now reversing. I am now pivoting. This is not, I've been burned the whole way. I'm up still after this week, up like 45% year to date. So, I think I'm coming from a pretty good place here. Used cars has been one of the largest components of CPI. We all know used car prices are up. They're kind of at the center of multiple forces, chip shortage, all the materials, labor, et cetera, et cetera, et cetera. Used car prices are down in April, quite substantially. Manheim Car Index is down. So my assumption is, we got that data today. Expectations, I assume, are not set today, were set prior to today. My assumption is we're going to get something lower than expected in CPI. It's possible that's wrong, but it's also possible that's right. That's a massive component of CPI, and certainly something that's propelled us up in CPI and kept us up. So if that's starting to roll over, I think that's a pretty optimistic sign. People are going to certainly notice that when they dive into that CPI report and look at everything. If there's a substantial drop in used car prices, well, that should be positive. Now, on the broader market, there's a lot of bearishness right now. We're certainly seeing that with the volatility. We're certainly hearing that with the commentary. I understand why people are bearish. They have very good cases, and what they're saying is not incorrect. Yields are rising. That's certainly correct. The economy is not going to be growing as quickly. That's certainly correct. We're not going to have the same kind of stimulus, everything that we had last year, again this year. The economy is not going to grow at the same rate that it did last year. However, I'm not super worried about the economy shrinking and contracting in a massive recession, at least right now. It's possible, obviously, I'm not 100% certain. Nobody is. We'll just have to see what happens. But the stock market is having a phenomenal move to the downside. Phenomenal. Stocks, and it's the type of move you only see when there's a systematic type of collapse situation. Stocks down 75 and 90%. There are more stocks down 75 and 90% than there were in March of 2020, when the stock market basically had its fastest crash ever, as far as I'm aware. Maybe 1929 was faster, but I would be shocked if that's true. I know March was more steep than the 08-09 crash and the dot-com bubble. And those are the only two times in the last 25 years that more stocks have been down 75% and 90% than they are now. And we're pretty close to the peaks in those levels. We're not quite there, but we're up pretty high. Obviously, valuations got quite extended. That shouldn't be a surprise to anyone. My point here is we don't know when the exact bottom is going to come, okay? Good luck. Ray Dalio says if you can do that, you should get an Olympic medal. What we can do is fundamental analysis and valuation decision making. Is this an appropriate valuation for a company? With stocks down so tremendously and this crash having gone on for 6 months already, it's my opinion that some stocks are certainly looking attractive, and I can't help but buy. I'm not really buying new stocks I didn't have before. I had stocks that I thought were well priced before, and I'm adding to those positions. Obviously, energy is doing phenomenally. I'm not necessarily adding to those positions because those stocks are up phenomenally. I'm adding to stocks that I love that are down tremendously, that might even be in those 75 and 90% camps, that are indicating possible bottom. A lot of people are concerned about rising yields, and I don't think anybody knows exactly where the 10-year is going to stop. But what I do know is that this is the most aggressive crash in the bond market since the 1980s. That's quite a long time. Sure, it makes sense, and I think the Fed's okay to see that. Nobody's really shocked that bonds have risen. But they can't rise forever. This has to end at some point, and we're 6 months into it. That's not the longest crash that's ever happened, but it's certainly a lot of time that has happened. Jerome Powell said earlier this year, and I know it's earlier this year, but guess what? It's still this year. And he hasn't shifted meaningfully hawkish since then. He shifted meaningfully hawkish in November 2021, and that's what instigated the crash, or the pullback, or the correction, or the bear market, whatever you want to call it. He said earlier this year, stocks, or bonds rather, will remain in an era of low interest rates. We're higher in terms of interest rates, but to think we could get to a 10% 10-year, I think is a little too extreme. So there is a cap on this type of situation. There is a cap. And we've been experiencing a pullback for 6 months. And it's the worst crash in the bond market since the 1980s. In the 1980s, they had significantly less liquid markets. So you were more susceptible to big crashes. There was that 22% thing in a day. That's not going to happen. We have circuit breakers. It didn't happen in March of 2020. Okay, when the entire economy was closing down, we did not have a down 22% day. I think everyone needs to take a deep breath. I think you have to take a deep breath, realize that possible downside is possible. You have to be prepared to take further hits. You can't be in the market expecting that stocks only go up. That has never been the case. People who believe that probably only half believe that. That's not true. When you take a deep breath and you calm down and you prepare to take additional downside, you can find quite fantastic opportunities. There's plenty of stocks around. eBay, for example, that's a company trading at roughly 10 times earnings. That's well below the S&P multiple. And as far as I'm aware, there's no other online marketplace that I can sell virtually any good right there. That company is not a new company. This is not a company that doesn't make money. It's more than 20 years old. It's been profitable for a very long time. It has a lot of history, and it has a fantastic product and a fantastic business model. Uber. I'm not saying Uber's a good buy. I'm saying it's a strong business. They're doing well. The economy is doing well. But their stock is well below pre-pandemic levels. Yet they're doing well. They've made it through, and they're expecting next quarter to be EBITDA positive. Do I think it warrants being below pre-pandemic levels? No. And it's basically almost at the bottom of the pandemic crash. So we've had an economy that's actually grown since pre-pandemic levels. Consumers are quite strong. Jobs are phenomenal. Phenomenal. You can't question that. Jobs are phenomenal. The American consumer is very good. The concerns that I think are warranted are around bond yields. Last time these bonds were this high was 2018. But they're still real negative. They are still negative in real terms. So you can buy bonds, but they still don't produce real returns. You know what does produce real returns? Cash flowing businesses that can adjust for inflation. That's where I'm parking my money. That's what I like. I understand that there's a lot of reasons to be negative. There's a lot of tension. There's a lot of volatility. But it can't last forever. And it's been going on for 6 months now. Almost 6 months now. It started in November of 2021, the 11th month of the year. You're now in the 5th month of 2022. I think it's time to, if you aren't already, if you are super bearish, realize that we may be closer to the bottom than we are to the top. And because we're closer to the bottom, it makes sense to start buying. One last example. People often acknowledge that Warren Buffett came in during the 2008-2009 crash and made fantastic buys. However, he did not make those fantastic buys at the absolute bottom. He made them about some 10-20% off the absolute bottom. I don't know what the exact figure is. He says that. He says, I didn't time the absolute bottom. What he did was, he made a calculation, he made a value judgment, and decided, is this company appropriate to buy now? It's at a good valuation. I'm just happy to own it. Yes, he did that, and he was patient. He was calm. He was relaxed. And he was confident in the asset he purchased. And over time, he ended up making quite significant sums of money. If you're worried about tomorrow, if you're worried about next week, it's going to be tough. Who knows what's going to happen? And uncertainty really sucks. Volatility sucks. But if you can remain calm and buy assets that you think are good, my assumption is a year from now, you're going to be doing just fine. Actually, even before the end of the year, probably just fine. Like I said, I think we're closer to the bottom than we are to the top. We're 6 months in. We're in the 5th month of the year. We'll see what happens. I think the second half of the year might be okay. So, we've been in this for a long time. Let's see what happens. And until next time, peace out.